Hi, everyone. Welcome to the second part of the Startup Financing series hosted by the Greek Tech Finance Network. I'm Talia, principal with Marathon, and today I am interviewing Nikitas Koutoupes from Insight Partners and Fidel Manolopoulos from Hermes GP on everything there is to know about raising growth capital. You guys can ask questions as well in the chat room, and my colleague Chris is gonna moderate that, and we'll try to take a couple at the end of the chat. So to set the record straight before starting this presentation, let me explain that we will be addressing founders and finance professionals, CFOs and heads of finance today, that have knowledge on how to raise a VC round. If what you're looking for is tips on raising seed, pre-seed, Series A round, let me refer you to the previous episode of this series, which is uploaded on the Tech Finance Network LinkedIn page on VC fundraising. Okay, so thank you to both guests for being with us here today. And let's start with brief intros. Nikitas, if you can tell us a couple of things about yourself.
Sure. Hi, everybody. Thank you, Thalia, for hosting us. I'm Nikitas Koutoupes. I'm a managing director at Insight Partners. I joined the firm almost 21 years ago, but I was born and raised in Greece, came to the US to study 30 years ago. At Insight, I have led both of our investments in Greece, and we're eagerly looking to kind of help the ecosystem grow and collaborate with firms like Marathon and others to continue to provide growth capital in the country. But by way of kind of broad introduction for Insight, we have about 90 billion under management. We're investing out of our 12th fund, which is 20 billion, which closed a couple of weeks ago. And we do growth software, consumer and internet deals around the world, from a $5 million growth equity check to a multi-billion-dollar buyout.
Perfect. Congrats on your latest fund as well.
Thank you.
And you, Fidel?
Well, thank you also from my side for having us, Thalia. So I'm Fidel. I spent the past 15 years in the growth equity space in Europe predominantly. Grew up in Greece as well, but then studied in Germany and worked out of Germany with initial growth funds there. And with Hermes GP now for the nearly five years. And Hermes GP is a bit of a particular investor. We are part of a larger asset manager, a US listed firm called Federated Hermes. And on the private equity side, we operate across the buyout, growth equity, and growth buyout segment. And we invest globally out of London, New York, and Singapore. We're a bit unique in the sense that we also invest in funds. So we kind of cover the fund investment side and the direct investment side. Across all these segments, personally, I'm focused on the European growth equity part of the market.
Perfect. So we are all looking forward to learning from you guys today. Let me start with a question directed to both of you, and starting with you, Fidel. Within the broader growth investing spectrum, which increasingly starts earlier on and goes all the way to investing in both public and private markets, where would you say that you guys stand?
So we cover a pretty wide range, and in Europe we go a bit earlier. So we look at businesses usually with 10 million in revenues on the lower end, and then upwards it could be in the 100 millions of revenues. So a relatively wide spectrum that we cover. But I would say in recent years it's probably more focused on the earlier growth, particularly the time that I spent on the investments is more on the late venture early growth. So businesses with anything between 5 and 50 million in revenues.
Okay, interesting.
And from industry segment, if that's also relevant, we are as a firm agnostic in terms of the segments. We follow a thematic approach, but in recent years we have done mainly investments in the software space and fintech.
Okay, good. And you, Nikita, where would you say that you might become relevant, and until what point?
We've broadened the range of checks we write over the years, especially in recent years. So even though our fund sizes have been increasing, the smallest check we can write has actually been decreasing. The idea is, in an ideal scenario, to be the first and the last check that the company will raise. But realistically, what happens many times is that there is an early stage investor, like a seed stage investor already, especially in a situation like the Greek ecosystem. And then we come the first growth capital check, albeit small, but then are eager to follow up and continue to fund the company for primary capital, secondary capital, and M&A.
Okay.
And obviously, there's a very, that extends all the way to much larger control transactions that we do for software companies, consumer internet companies, marketplaces around the world.
Let me ask you a follow-up question, which would be, why would a startup founder decide to add the insight or a growth investor in general to its cap table? What would insight bring to the table other than capital, basically?
The idea is that in the growth stage, you can begin to do a lot to affect the outcome of an investment. There is, while growth cannot be, there is no kind of prescriptive recipe that the company can follow. There is a lot of pattern recognition. There is a lot of resources that the fund can make available to make a real difference in the growth trajectory of a business. There's 400 odd people at Insight at the moment, and a third of them, their entire job is dedicated to helping the portfolio post-investment. So we get really kind of granular in how we assist our companies, not in a way that is kind of top-down command and control like the traditional kind of private equity model. It's more working with management teams to make sure that either we provide expertise that they need, but they cannot yet have full-time in areas like pricing, say, or M&A, or we help vet experiments that would otherwise take a lot of time of the management team. Our team can provide leverage that those experiments are vetted and either are funded and become part of how the business proceeds, or we just pull the plug and no one has, and there's efficiency that gets created. So that's the basic idea.
Perfect. That's actually very interesting, especially as opposed to different type of PE investing, as opposed to growth investing in tech companies.
Yeah, and it's the ability to use a larger fund size kind of creatively to assist the portfolio, because we can, in fact, afford to have all these people and dedicate these resources back into our investments.
Perfect. And you, Fidel, how would you say Hermes helps founders, obviously, other than bringing capital to the table?
Well, I would add to that the question about what are the alternatives, right? What are the alternatives to going with a growth investor? And I guess there are a limited pool of other pockets where you can find financing for your business in the growth stage. Either it's an VC fund that goes extended a bit higher, or it's a family office that comes in, or a corporate. But as Nikita said, the question is, where can you find somebody who has experience and done it before, right? If you find a family office, they might have particular sectors expertise where they can be helpful, but they probably haven't seen, the tens or hundreds of businesses that go through the same developments, right? And as Nikita said, it's a bit of a pattern that you recognize as these companies grow. They usually encounter similar challenges around the organizational buildup, the hiring, the management that's needed, the sales process and the sales organization. Nikita's pointed out the pricing of a product. There are often similar patterns, which usually a growth investor has gone through, tens or hundreds of times, and he can apply his experience to the next company that they're talking to. The alternatives, as mentioned, are probably a bit more narrow in their experience. If it's a family office with a sector expertise, or it's a corporate again with a specific expertise, but probably not the breadth of businesses that they have seen going through these challenges. Now, I guess having said that, all growth investors will tell you how much they are helping and how much they're getting involved. I think at the end of the day, one key component is being a partner to the founding teams and to the management team, a trusted counterpart where they can have open conversations, get feedback, but they can work with. And Nikitas pointed that out. It's not the traditional private equity model, usually where it's very much top-down directing the management, but it's more of a collaboration with the management, trying to work together with them, even if it means bringing in external people. It has to be symbiotic with the overall organization, right? You cannot, in a high growth business, in contrary to a buyout scenario, you cannot force in a management to take the company run, or at least usually you cannot do this.
So in that sense, it is similar to what us early stage investors are trying to be for the companies. Okay, so thanks to both of you. I think it would be useful if we try to understand the growth equity investing model so that we understand the incentives on the table as well. So Nikitas, as a first question, I think we'd like to understand what is a meaningful stake for a growth investor, and if you can very quickly take us through your model.
Perhaps the most important thing to say is that this is not a one-time decision for us, nor should any fund necessarily see it that way. The reason that there's such a wide range of checks that we write and a wide range of ownership stakes that we end up with is, well, I guess two. One is we view this as a multi-round event. Once you like a company, once you understand that it has the ability to disrupt its market and create value, it doesn't make sense for you to overfund them just because you want to justify a specific check size given the size of your fund. It makes sense to provide the capital that the company needs, and then be on the same side of the table with them and understand how the business scales, help enable that growth, and then opportunities just naturally arise. It just becomes much simpler to lead the next round because you almost by definition would know the company better than anybody else from the outside. And also opportunities like as I alluded to earlier, M&A or secondary capital or early stage investors who are sitting on a great return and want some liquidity. So there's always the ability to create enough, again, if you think that the opportunity is large enough upfront. And in the same vein, the percent ownership is kind of a misleading number. It can mean absolutely nothing in most cases. Like owning 3% of a company that has the ability to be $100 billion outcome can be more than enough. And owning majority of one that is a big fish in a tiny pond will not be enough anyway. So it's more about kind of absolute dollar outcome to justify the resources we bring to the table in the life cycle, over the life cycle of an investment. That's how we typically look at it.
Okay, that's very interesting. So you build that up also gradually.
And obviously not forcing the situation. It's the worst possible thing to do, to kind of bring your own kind of particularities to a deal. You have to react to what the company actually needs.
Perfect. So would you say, as you build that stake up gradually, is it a common route to also acquire founder or employee secondaries other than existing investor secondaries?
Absolutely, but again, you can't force it. What we're there for, the only requirement we have is that no matter how big the check we write is, no matter what it's for, once it's done, the people who are around the table trying to help the company improve and create value have to be as aligned as possible. So providing too much liquidity to someone who is critical to kind of shape the company in the future is probably not in the best interest of the company. But providing some liquidity to founders so that they can, many of whom are in the, all of my eggs are in the same baskets category, having providing liquidity in that type of situation so that they can have the same risk profile as you. They can afford to be a little less conservative and not leave money on the table for the rest of the shareholders. So yes, and also if you are part of a company, then it should make zero difference what another investor chooses to do. Maybe they've been there earlier. Maybe they want liquidity for their own kind of particular reasons. It doesn't say anything about the quality of the business or the potential. So yes, very much we find ourselves in positions where we increase ownership stakes as long as that alignment criterion is satisfied.
Perfect. Thank you. And going on to the exits, if Fidel, can you take us through the possible exit scenarios for a typical growth investor?
Sure. So I guess on the exit, I guess there are a few routes that a company could take. Right, it's a strategic acquisition of the business. It's a PE acquisition, or it's an IPO. And usually for an investor, they come with pros and cons, and it's probably not one where you can say it's one size fits all, right? It depends on the particularities of the business and which is the right route for the company to go. Or in some cases, it's a dual path and then leads to one direction. But what is helpful for companies to make up their mind what the potential paths for a company are. So thinking about a PE exit, it's the particular profile that you need for the business to be able to sell it to a PE firm. And usually this means that the company has to either be profitable or have a good case around profitability. And these are all cases where we talk about the full exit of the business, right? If you want to sell a minority, there are maybe other paths you can go for if you're a founder and you want to sell a minority. But for a full exit, I would say it's a strategic, it's a sell to a PE house or a recap within for a PE, which both means that usually it has to be either profitable business or going to profitability, and then there's the IPO route. And on the strategic side, I think that's where historically at least you would have seen the premiums, if we carve out the past 3 years maybe, but in the more normal terms, probably the strategics have been the ones that would have paid the premiums for a specific asset.
Okay. Staying a bit on the IPO route, I have a question. Who really decides on timing? Does a private equity help with financing gaps in case of delays in IPO, like you would have now, for example? Or is it typical for PE investors also to have a favorite stock exchange where they list all their companies, or is it a per company choice?
I think you're assigning too much power to what we can actually do. Yeah. No, in fact, yeah. So going pretty much in reverse, no, the stock exchanges, it's the management team, often with involvement from several board members that will evaluate the options of whatever stock exchange. Like, if it's a European one, the kind of the geographic distribution of where the business does business will kind of dictate where you go. In the US, most of our companies get pitched by both the New York Stock Exchange and NASDAQ, and it's the type of coverage. Each of them have become very good at marketing their own services, their own differences, and then the management team, the board decides. In cases of disruption where the kind of the new issue window is closed, there is an entire kind of sector within the broader buy side that specializes in these types of either crossover rounds or mezzanine financing right before the investment. So there is no, in fact, you can probably say this for any round, but there is plenty of availability of capital no matter what contingency. As long as the business continues to do well, I don't think that capital will ever be constrained just because of what's happening in the markets, at least unless the world does not deteriorate a lot more from where we are now. And I certainly hope for more reasons than capital that it doesn't. And then in terms of kind of the preparation, the timing, IPO prep is a very serious exercise. You don't wake up one morning saying that I'm going public the next morning. It takes at minimum a year, if not 18 months plus, to get the company ready. There's a lot of chief financial officers on this call. Like, it's a lot of work, particularly for the CFO. Getting the business to a state where it can be predictable is critical, because that's what the public markets requires, especially given the how punitive kind of missing earnings can be in markets like what we have now. So yes, that's certainly an issue. So normally the timing gets dictated by the readiness of the company. Like, we have an entire module within our team that assists the portfolio around IPO prep, and it's a long checklist affecting many parts of the business, and it's a long road to get there. And by the time you're ready, the market also has to be open. So so it's a bit of a dance. The good thing, though, and I'm sorry for being verbose, but the good thing is that plenty of things that you need to do to prepare to go public are things that the company should be doing at this certain scale anyway. A robust financial planning team, the ability to predict what will happen. ESG is becoming increasingly very important. Independent board members. So there's certain things that need to happen to help the company, and those things we do regardless at a certain scale. There's other things, like investor relations and things like that are less required in a private business. So those we typically leave for the very end, because you only need those when you know absolutely that you're going to go public.
So naturally, some things are developed in a company as it grows. That brings it sort of naturally to that stage to go public.
That's right.
Okay.
From the European perspective, I guess in Europe we have notoriously being bad in timing the markets. So if you look at the events in the past 20 years, I think we've always been too late in Europe. So I would be very cautious around, because I agree with the timing is often with the business, but timing the market itself can be very, very difficult. And in Europe specifically, with the different stock exchanges around Europe, it becomes quite challenging picking the right one, the right timing, and the right approach to it. And usually, if you have the route to the US, if you have a US presence, a US listing, is maybe a secure path if it's an option.
True that. Okay. I'm gonna take this on to the evaluation stage, and I want to ask Nikitas. In the earlier stage, we pay more attention to product and team when we evaluate an opportunity. So, what aspects of the business become increasingly important when you come to cross that threshold that you are sort of eligible to raise for growth? What other aspects of the business are important when you look at the company?
I think the way you put it is right. It's not, these are aspects of the business that are in addition to what in early, of course the market has to be great. Of course the team has to be great. Of course we have to, feel like we can work together well and enjoy each other's company, because we're going to be through a lot together if we end up investing. And if the product doesn't work, it's a hobby. It's not a business. So it's not, that's, of course. But by the time the growth stage begins, there should be, and again, what we do is so broad that I cannot, I don't want to generalize. I have to generalize, I guess. There has to be a mark, like your unit economics, your income statement should reflect how that great team and the great product are meeting that great market. So what we can do and what we do in almost every deal is try to figure out how that story, the traces that it's leaving. In early companies, we look at things like pipeline. We look at things like net promoter score. so leading indicators of what's of growth. But as soon as you have some kind of pattern, for instance, of renewal, we pay very close attention to those to your unit economics, because there is no substitute. It's very hard to explain away poor unit economics. Whereas if you see for instance, great net retention, speaks volumes about the quality of the products, right? So that's mostly what we do. And the more ability we have just generally to go bottom up, the more customers we can speak to, the more we can, analyze your raw customer data file to understand kind of behavior patterns in renewal, in upsell, in cross-sell, etc. The more conviction we get, again, assuming that this data is available given the stage. But that gives us a ton more conviction for doing a deal.
Okay. And as a follow-up question, do you have some indication of typical growth expectations of a growth investor? So coming in a company with, let's say, like 10 million in revenue, is there a standard expectation to achieve a revenue multiple in the longer term for the startup?
Again, it depends on the absolute size, but for the growth, so for a $10 million company, you want to see quite healthy, like ideally will be more than 100%. A lot of the deals we do fit that criterion, but at least, I don't know, 60-70%, with the potential to keep that up as the business scales. For smaller companies, higher growth rates. For larger companies, we start looking at things like the rule of 40, rule of 50. So the sum of your growth rates and your margin, if you're profitable. So, but that's for far more mature companies.
I see. Thank you. And going over to Fidel, if you can quickly take us through typical due diligence items that are requested as part of a growth round. We all here, I mean, most people in the meeting room will have done that for a VC already, so they have some experience. But what would you say, Fidel, are the parts that again become increasingly important in the growth stage, in the data room?
How much time do we have? Where do we start? So I guess again, as Nikita said, I think it's we can talk in general terms, but at the end, it very much depends on the specific business, right? And I think for every investor, the first step is to understand what the business, how the business operates, and what the metrics really mean, right? And there are some cases where it's very easy. If it's a standard, SaaS software business, it could be very easy. But in many cases, there's some nuance and some complication in the way the product is sold, in the revenue lines, in the business model. So first and foremost is for any investor to understand what these numbers really mean. And as Nikitas pointed out, often it is easier to drill deep into the actual clients and see what is actually sold to the client, and either by example or by taking the full list of clients and just raw data and working through this through this data, because it really comes down to understanding what a revenue line really means and what it means for the customer, right? And then you can reaggregate it on a higher level. And what are the metrics on a high level that are relevant for most growth businesses? It is first and foremost the top line growth. Now, if it's a software business, it could be just a revenue line. If it's more of a marketplace, it could be GMV or similar metrics. But then it depends on the margin on that. So looking at gross margins or contribution margins, again, depending on the business model and what it actually means. Even on a rather simple SaaS software business, they could have very different margins that they're operating on, or they could have different services components that come with the product. So taking this apart and really understanding what the business really means is the first and the most important part of, I guess, any work that an investor will do. Then I guess more generally, Nikitas mentioned the retention and the churn of businesses. This is a metric that helps most investors a lot just to understand that it's more of a sticky product. You can build on the sales that have already happened. So, and this is kind of an evolution of the market, right? If you think about back like 10 years ago, it was perpetual license models that most of the software businesses were selling, and every January the sales team went out to sell again, starting from zero, right? The nice things today with most models that they are recurring or reoccurring models, so you can build on the revenue line that you have worked for over the recent years, and likewise, the retention, it gives a good indication for an investor how much conviction he can build on the revenue lines that he is coming into. So I guess, long story short, to say that it is top line revenues, understanding the model and the margins, and then understanding how sticky this product is in terms of net retention, cohorts, unit economics, and so on. But from the answer, you already see that it's very much around the data and the metrics of the business. Not ruling out everything else around the market, the product, the management team and the founders, but metrics become more of an instrument that you can work with to understand the business and what the team has achieved so far.
So from your answers, I hear raw data and actual client interviews. The more we chat, the more I feel like it's pretty much similar to our process of due diligence, rather than that much different. But yeah, you just have more data to work with, I guess.
It better be, right? Otherwise, one of us is doing something wrong.
Yeah. Okay, so let's move on. Fidel, can you move us on to the closing of a deal and take us through the typical terms of a term sheet this time? Again, most people here have seen a term sheet, but just that of an earlier stage investor. So basically what I'm trying to understand here is what are the main differences on the term sheet and the deal level, on the financial and on the control terms?
So I guess on the basics, it's probably not all too different. I mean, at the end of the day, it's a short document giving the high level terms to engage in a process, right? So it should not be all too different on a high level, but there are some nuances, I guess, where you can differentiate, I guess, a little bit. And you touched on a few of them. I guess in many cases for a growth investor, I would say that he might have a bit more its hands on the events and on the things that are happening. So maybe more on the veto and control rights if it's a minority position that they're holding. So definitely things around the budget, hiring, acquisitions, and similar things want to be very much in control or being involved in. And then obviously anything around the exit route. I mean, you have the obvious tag and drag rights that come with it, but in many cases, the investors want to be relatively involved. Similarly, on the board and the board constellation, because again, it comes down to having a group around the board that the new investor can also work with and believes that this is a sensible set of people. And what might be a little different, which probably goes later than the terms, is just the reps and warranties that might be a little more stringent and a bit more in there just because of the past and the history of the business.
Okay. I have a question. Some sort of terms that are, for example, super pro rata, or more than one times liquidation preference, whatever that more is. These seem a bit exotic to earlier stage investors and therefore to founders as well, because they haven't seen it before, if anything. So I'm sure there's a reasoning behind these terms. Can you take us through the reasoning for this sort of terms?
Well, I would say there are different investors. So again, we have to talk in a bit general terms. There are different investors and different situations. So usually the super pro rata is not a thing that's too common in the growth stage, but in case of Nikitas might be different as they invest through different rounds. But generally, it's not something that is very very common in terms of super pro rata. So you mentioned a few other points.
So super pro rata is really a way to build up your stake when you come in early, to sort of build up your stake going on. But how about more than one times liquidation preference?
Yeah, that's a fair point. And there's, I think, where it depends on the situation of the business. So I don't think today it's probably not the norm in a growth stage business that you have anything else but a non-participating preference. But there are cases where you use this. At the end of the day, the liquidation preference is a pricing mechanism or valuation mechanism. But usually when you have things like a participating preference, a 1x, 2x, 3x preference, a interest or a coupon on the liquidation preference, these are usually a bit more particular cases. Either there has been a very high valuation and the new investor wants something against that as a protection, or it's more of a restructuring where you don't want to have a down round and kind of dilute all the previous investors on paper. You put in a preference with a 2x or something like. So it's an instrument for particular situations. But I would say in the normal growth, everything is going well, we keep on growing and we're going one direction. Usually it's not the case. Usually you will not see any of these particular preferences coming into play.
Okay, perfect. That's useful. Okay, Nikita, if I may ask you, how do the board dynamics change after a growth round? Usually before the growth round, you have like maybe one or two VCs and maybe a couple of founders on the board. How does that change when you admit the growth investor to the table?
I mean, hard for me to compare because we're not in the boardroom prior, but all I can answer, I guess, is how we view the function of the board. The board is not there to inform the investors. If I learn anything during the board meeting, it means that I'm not doing my job between board meetings. This is not a slide death march every 3 months to kind of have every department kind of report. Normally, when we enter an investment, there already is a sense of key areas of priority that we want to work with management to go figure out together. So those initiatives get underway even before the first board meeting. A lot of people from different parts of Insight will engage, and hopefully traction will occur. The board meeting becomes a way for management to get the feedback of people who, more than likely have broader perspectives through experience and through many portfolio companies on things that are top of mind for them. So we typically reserve board meetings for discussions on things like growth strategy, and should we change our pricing, and should we buy this company, and what is the path to an exit for more kind of mature companies. Also, it's a wonderful way for management to showcase particular leaders, where presenting to the board is also kind of an indication that they're doing particularly well. So those are the types of dynamics that we encourage, where a successful board meeting is more about, does management have new thoughts, new ideas, new access to help when the meeting is done, as opposed to, do the investors know what the receivables look like for the previous quarter.
Perfect. That also helps the finance guys on the call understand more what you're looking for.
We still need the receivables, just not on that day. It will be, because without receivables, we can't afford to have a board meeting. Cash is important.
Okay, as a follow-up question, how do those dynamics change? And in general, the dynamics and the shareholding of the company when the PE has the majority. So as you accumulate stakes, often you will come at the end holding, more than half the shares of the company. What is different then for founder?
I mean, I will give you the answer that's this is a very insight specific answer, and I don't know. In fact, it's probably different from what the perception is. If you invest in growth, you cannot be top-down prescriptive. It's not, the moment our ownership flips from 49 to 51 of a company, it does not give me some kind of right or ability to go run the company on behalf of our founders, right? So from one perspective, nothing really changes because we're still counting on the teams that are running the company to create value. So it's more of a reality of the capitalization table as opposed to you wake up the week after and all of a sudden your job has changed. Even in non-control situations, as I'm sure plenty of people on this call will know, there are things that, there's processes, there's people, there's things that need to change as a company grows. Like what got you to 10 million will not get you to 100 million, will not get you to 250 million. So there's certain things that have to be broken to be rebuilt if you want to scale. But that's not a function of who controls what. That's a function of we will yell about that loudly, no matter what percent of the cap table we happen to occupy.
I see. That's actually very useful to understand. And private equity is a broad term. Equity is also what the venture capital gets at the end of the day. So private equity is a very broad term. And often you misunderstand the growth investor for the more traditional model that has nothing to do with growth tech investing. So it's good to know these things and to clarify these things. And as a follow-up question that we got from the more closed tech finance group in advance of this meeting, that is on the same track is pushing to grow revenues and pushing on a very specific growth path. How do you ensure, well, I guess you can't ensure really, but how do you safeguard the product itself and the product development and the focus that stays on customer service too?
Do you want both of us to answer this or me?
Either will work. Yeah, let's go with you, Nikita, since you were the one.
I think both of us alluded to this, that after a certain point, unit economics is all you need to look at to figure out as whether or not things are working. If you're pushing too hard to sell things that are vaporware, people will not renew, right? You can only fool them once. They will not buy more of what you have to sell. So it will show up sooner than later. And by the way, even before that, it will show up when we speak to those customers or prospects as part of due diligence. So no, I think there is such a thing as bad growth. Don't get me wrong. There is such a thing where companies, we run across negative gross margin businesses all the time, and some things you cannot make up with volume, right? We do come across businesses that, because they've raised a lot of venture capital, they continue to scale, but with totally upside down unit economics, where it feels like you're catching a falling knife when you look at their income statement. But if the business if the management team tracks the right metrics, things like net retention, things like unit or gross retention, things like net promoter score, even employee satisfaction internally, how many people, what is your percent of unwanted retention every year, which in a war for talent like the one we're in now is a critical metric. So if those KPIs are solid, it's very, very unlikely, if not impossible, for your growth to not be a source of real value, even if it takes you capital to even if you're consuming capital, significant capital, as you're doing it.
Yeah, and I would just add, to your question, Thalia, is the challenge of building a business from 50 to 100 to 200 to 500 employees is exactly the point that you made. That you don't have the option to leave your eye off the ball from any of these areas, right? You have to do all of it simultaneously, right? You have to build the product, you have to keep your eye on the customer, and you have to build out the metrics. And this is, I guess, the challenge for CEOs growing with these businesses, that it's not one or the other. It's, you gotta emphasize on all parts of the business. You have to be a CEO across the entire business, or you have to be a management team that covers all parts of the business and drive them forward. And then this will come through in the metrics and the unit economics.
Perfect. Thank you both. So let's try to take some more questions from the audience now. We have a question whether growth capital would be a way, the right way, the appropriate way to finance a new proposition. Let's say you've got a company, the way I understand it, that's already solving a problem, and you want to solve another problem that the same market has. So this is a new opportunity. Should it be addressed by raising growth capital, or do you solely invest in companies that do one thing and they grow the usual VC path and then PE?
I guess I would say it has to be related to the core business, because you have to be able to replicate something where the investor can see this is a model that worked, and then we put it somewhere else, and we know that it's going to work. It's going to work again. Otherwise, any growth investor would take more of a venture risk in the unknowns of venturing out with something completely new.
Perfect. Thank you for that. I think that covers it. And then on another topic, what is your opinion? And I'd like to take that opinion from both of you guys with regards to non-dilutive debt. So venture debt or other types of financing, so like lighter capital, flow capital, founder path, stuff like that.
Free money is always.
Go ahead, please.
No,
you're closer to than I am.
No, you said, sorry, go ahead.
So I'm biased, having been on the in situations where that decision has come back to haunt the company. In general, debt should not be viewed as a substitute for equity in the growth stage. Debt should buy you time, and that's about it. So if you're trying to bridge to something that you know is certain, and you think, but the equity world doesn't, then it's fine to raise venture debts to get to that outcome and then convert that into equity. The problem with venture debt is that if you raise it in lieu of equity and you're wrong, it's very hard to recover in a way that is helping the business. It's too punitive on the downside. So the same way that Fidel correctly described certain mechanisms that we have if things go south, to do equity financing that still protects us but still funds the business. Mm-hmm. Debt has just fewer degrees of freedom in that respect. You get from a few mistakes that could be corrected to something that could be quite punitive and destroys the business. So I would be very cautious. There's a place for it. Obviously, there's use cases for it, but I would be very cautious as a team to think about, for anything other than working capital management, how do you want to use it? And I would be very cautious.
Yeah, I was just joking, but at the end of the day, there is no free money. And even though the past couple of years made it seem like there is, particularly on the debt side, as Nikitas pointed out, the debt side, I mean, it is debt, right? I mean, and the lender is in a very different position if things go wrong. So I would agree that you should be very cautious about over leveraging a business, even if the headline terms seem particularly interesting, and even more so in the current market environment. We are in at least a direction of travel that will return to different lending environment as it seems. So I would be cautious in over leveraging a business today.
If you look not so far back, if you look at companies that many of you may know that did not make it through COVID, I suspect that you will find a disproportionate amount of companies that had borrowed as opposed to raise equity. Because when a crisis, when a shock happens like that, it's just very hard. Debt cannot be patient just by design.
That's true. We tend to hear equity free, but we forget that the equity comes with the risk sharing part to it, right?
Like
so
Fidel said, there's no free lunch. There's a price for everything.
Yeah. So that's I think a good question, and we'll keep all that in mind for we're going to hold the future event on venture debt. So let's try and leave that for that time. Try to figure out what's the good parts, the good points in time where we can use that to our advantage. Moving on to a different question. So here's a question from one of our own partners, Manolopoulos, and he's asking, what makes a company an M&A target for Insight? Does it have to be a portfolio company, Nikitas?
I'm not sure I understand, although Panos is far smarter than I am. I'm not sure I understand the question. M&A for and not on behalf of another portfolio company, you mean?
No, so I'm assuming that he means for you. Do you only gradually build up your stakes to end up like owning a majority of the company, or can you just come in? I think that's the question.
Oh no, there's no predetermined ownership structure, nor is it like when we write a small check up front, there is no kind of master plan in the background to switch to majority. No, there's often a plan to continue to invest more capital so that we can increase our stake and put more money to work, but not with majority as the objective.
So what makes a company a target for you?
Great products in a big market that will scale, not using people or hardware or real estate or credits, but they will do so using intellectual property. That doesn't mean you have to be selling intellectual property, but it means you have to be using it to grow.
Thank you. And a question on the IPO or the exit event as well from Elena. What other financing tools could be combined with private equity financing to get you all the way to exit or to IPO? So is it usual that you have a combination of private equity capital and some other option, or is it the one-way route?
I would say, I mean, the alternative is a debt financing, and I think usually they play hand in hand, in the growth businesses. I guess big part is that a venture debt provider wants to see some security from an equity investor in the business so that they lend to the company. So with that, they usually go hand in hand. If the company is much maturer and the company is profitable, there are times where it can be only with lending, but we just mentioned the risks around lending, and it's one thing on a profitable business. It's even more it requires even more cautious on a loss-making business when you take venture debt or any other kind of form of debt.
I understand. You guys do a lot of due diligence for free for the debt guys. The way I've understood it, usually you raise like a private equity round, and the debt guys contribute some sort of proportional amount to that, right? That's how it usually works.
Well, they know that we are full in the risk, right? We have maybe more to lose than they have.
Yeah.
Right.
Okay. So another question in the chat room is whether you look, I mean, I guess you both would look everywhere, but do you look also in opportunities in frontier markets like Africa or MENA? And if yes, do you have some particularities in these markets?
We do, and we have, but there's two kind of criteria for us. One is that the macro risk, the country risk, the regulatory risk, the political risk cannot overwhelm the execution risk, because the company can do everything well and we still end up losing money for reasons that we cannot control. So that's an issue. The other is that because of the, especially in more remote markets, the quality, the potential of the business, even if it meets the market risk criterion, has to be high to justify getting the resources that we typically give to a US or European company to work in, strange time zones with a lot of travel commitments, etc. Although that line is also being blurred more now with Zoom and virtual environments. So, but yes, the primary, the first piece is what I said. It's the macro risk.
Perfect.
I would
Thank you.
At the FX risk, the currency risk has been very punitive for us in investments in Africa and Turkey, for instance, where the companies have performed stellar, but currency has just diminished the returns.
Okay, interesting. I'm going to bring that question over to Greece and to our tribe here, Greek founders, and the model that is very common here, as we said before. So the subsidiaries, R&D centers, cost centers in Greece, and the headquarters elsewhere, London or US. And I'm going to build on something that Nikita said before, and just check that this is the path for you guys to enter an investment from a Greek founder. Is it the most common route, at least? Would it be that you have some sort of validation, like a Greek VC, like Marathon or any other, would usually do the seed or the pre-seed check, and then it would come straight to you guys? Would another European VC be in the middle? Or would you go directly maybe in the Greek market, or do you want like some sort of de-risking again from a Greek VC side and some more product market fit towards that end? What's your preferred route to Greek founders?
From our perspective, it's not a question of having a requirement or a criterion. It's more a question of companies that have raised from the current ecosystem are just more visible to us. It's just easier for us to find them. That doesn't mean that for someone who doesn't belong to the financing ecosystem, if the business is great, we'll invest in it. So it's not like we're looking for some kind of early stamp of approval. It's our job to assess businesses. But it just so happens that so many of them, it's more of a visibility point. I do think that, by the way, because it's not accidental that, we've invested a couple $100 million in Greece, and I would love to do a lot more. But it's only been recently, and I think it's because of the local ecosystem. It's very much a post-crisis turn of events. I think it's a lot of the transition from the, maybe it's a harsh word, from the kind of the predatory VCs that we saw 10 and 15 years ago within banks. We've switched into founder-friendly businesses where the principals were founders to begin with. They understand the space. So I think the crop of companies that is emerging from that ecosystem is higher quality and led by smart kind of collaborative investors. So I think there's a lot of great self-selection there for us to come in and follow and collaborate.
Perfect. That's good to know. And you, Fidel, what do you think? What's your preferred route there?
So as a firm, we have not done any investment in Greece. Yet, exactly. I would just say that, we shouldn't forget that it was like 6-7 years ago, we still had capital controls in Greece. So there had been a bit of a disruption or a significant disruption in the business as usual, I guess, in Greece. So, companies putting headquarters in the UK or somewhere else in Europe or the US partly has also been just at that time, at least, to have the secure bank account somewhere abroad, a bit more confidence to the investors. Now, this has very much changed. And the ecosystem in Greece has changed a lot, in big part because of VC funds like yours, where you have been very active. Not only in fostering the market, but also the entrepreneurs themselves. I would add one more thing. I think the ecosystem of the market has definitely developed, but often when these companies come through a VC like Marathon, there has been a bit of preparation, let's say. They have worked with an investor before, they know what to expect. It's not very unprepared going out and talking to a growth investor abroad, which might be more challenging, more disruptive if they don't know what to expect. If a growth investor comes to particular terms that a liquidation preference or a veto right, and an unexperienced founder sees that, he might react very different than if he's prepared about what to expect.
Okay, thank you both. And I'm going to take one final question from the audience, which is what is, and I think that would be of interest to many founders that are with us today, what is the earliest stage that growth investor would come in, actually that Hermes or Insight would come in, and does this differ per vertical? So is it different depending on the vertical? We'll start with you, Fidel.
So I do, it depends on the vertical. I'm not talking just about us, but it definitely depends on the vertical. So if you go very way off in the medtech space, it's obviously very different, or in some of the deep tech areas, it might be different as well, just because of the nature of the businesses and the revenue generation that comes with it. So yes, it has to do with the sector. For us specifically as a firm, we probably wouldn't go in businesses without a proven business model, clients, revenues, some of these metrics that we have talked about earlier.
So I would have given the exact same answer a few years ago, but recently, because of what I alluded to earlier, we have been making, in certain industries where we see the opportunity be big enough and the product is stellar. Like I've personally led 4 pre-revenue checks this year. Over the last 12 months. But these are smaller bets for things that have high potential, where it's not a function of the vertical, it's a function of how big do we perceive the opportunity to be.
Okay. Perfect.
But we're not going to set up shop next to Marathon and compete with you.
That's good to know, actually. Good. So thank you to both of you. This has been great. It has been very educational. I hope everyone else enjoyed it as much as I did. Let me just say that we have 2 events coming up. And we have one early next month, on venture debt, which we touched upon today. We're going to do another one specifically on working capital financing and revenue-based financing. And you can all stay tuned in the Tech Finance Network LinkedIn page for announcements. Again, a big thanks to both our presenters for staying with us today, and to everyone else. And have a nice evening.